So today we want to talk about actually what is one of my favourite topics, Superannuation Unpacked. Bit of excitement this week where the government, who said that they weren't going to touch super, are now announcing some potential ways in which they are going to touch super. We'll see how that ends up landing. But yeah, just to introduce today on your speakers. So myself, I think I've probably met half of you by looking at those who are attending today. So my name's Shannon Smits. I'm the founding director of Smart Business Solutions. I specialise in financial advice, also in accounting and tax and mortgage broking, but in particular, I have a very strong interest in self-managed super funds and superannuation in general. Joining me today is Bianca Carroll, that many of you have got to know over the years. Bianca's been with Smart for quite a number of years, started off as administration and then found the passion for financial advice. And as she did, she overachieved in achieving her Masters in Financial Planning in a record timing, also topped the country in one of her subjects that she undertook, near perfect marks for that one of her subjects as well, and has now gone through a professional year last year and is now a fully licensed financial advisor. So I'm really pleased to see how Bianca's progressed across as she's gone through her journey. So to go through a bit on today and to go through a bit on the agenda of what we want to talk about, really, why does superannuation matter? Actually, why should you care and focus on it? How superannuation works, and then what some of the smart superannuation strategies are that we have, and then how you go about accessing it at the end, and what can you do to also take control. So to pass on that control, actually, now that Bianca's a financial advisor, I have been pushed aside. Bianca's going to start taking us through today's presentation.
Thank you, Shannon, for that super introduction. Why super matters, such an important question. And the answer is, you're working hard for your money and contributing to your super in your working life, and your super is invested over your working life to prepare you for your retirement. So super really matters because it is your money and you deserve to have a choice of where your super is invested. So during your working life, your super is an accumulation phase because it is accumulating. Your super contributions go into your super account in the form of superannuation guarantee paid by your employer into your super, which is currently 10.5% of your income, or through personal contributions. So your super is invested in various assets such as stocks, bonds, cash, ETFs, annuities. And when you're ready to draw down a pension from your super, you can transfer your super, part of your super or all of your super, from accumulation phase into pension phase. Your pension phase super is also invested in various assets. Depending on your asset level, you may be eligible for the government pension also. So in retirement, you may be receiving income from a few different sources. If you have investment income outside of super, you may be receiving that along with your pension from your super, and you may also be receiving the government aged pension as well, depending on your income and assets. So if you are receiving the government age pension as well, you do need to draw down a minimum amount of that pension, and that will depend on your age at the time in the government regulations. So Australians are living longer, more active lives, which means we're spending more years in our retirement than ever before. And many of us have higher expectations of what we want to do in our retirement. For example, you might be considering downsizing, making a sea change, or travelling around Australia or overseas. So to ensure you have a comfortable lifestyle in retirement, planning ahead is vital. And your retirement plan will be based on your individual financial and lifestyle goals. And to set your goals, it helps to ask yourself some of the most important questions. Do you have a specific retirement date in mind? Do you want to stop working at once or gradually reduce your working hours? If you have a partner, do you want to retire at the same time together? And how do you intend to spend your time when you retire? Are you hoping to travel? Are you going to downsize the family home? Looking longer term, what are your goals and how you'll reach them? So remembering that you should be planning for spending at least 20 years in retirement. As we are living longer, it might be more, of course. So it is really good to get those long-term plans. And finally, how much income will you need to maintain the lifestyle that you are wanting for your retirement? So let's look at where the money for your retirement will come from. So first of all, you have to think about the kind of lifestyle you see for yourself in retirement. The Association of Super Funds of Australia, ASFA, defines a modest retirement as one where you only eat out rarely, enjoy occasional low-cost leisure activities, and take short holidays near where you live. And for this type of lifestyle, they estimate that you'll need around $30,582 a year, as a single person, or just over $44,000 a year as a couple. So this means you'll need at least $70,000 in your super at retirement, but that's if you're relying fairly heavily on the government aged pension. So on the other hand, ASFA defines a comfortable retirement as one where you can afford to eat out regularly, enjoy leisure activities and holiday overseas. And to fund this type of lifestyle, a single person will need just over $48,000 a year, or $545,000 in their super at retirement, with a couple estimated to need just over $68,000 a year between them, or around $640,000 a year in combined super savings. So as you can see, there is quite a big difference in these figures. So let's take a look at superannuation, one of the most effective ways of building a retirement nest egg. How super works, another great question, another super question. So a lot of people sign into their super provider and their super ticks along until retirement, a bit of a set and forget. I know I did this before coming into the financial advice industry. I had no idea, my super just sat there and I logged in every now and again and I'd get a statement. I had no idea what it was. So wouldn't it be great to know how your super works so you can get more for your money? So when it comes to affording a comfortable retirement, your superannuation is potentially the most valuable asset you have. Australia's super system is designed to encourage you to save money for your retirement by making regular contributions into your super account. So your employer is legally required to make a fixed proportion of your income into your super account with every paycheck. So at the moment, as I mentioned, that's 10.5% per year for your income per year. And these contributions are known as superannuation guarantee, or SG payments. And you can also make personal contributions on top of your employer's SG payments, but that will align with the caps every year, and we'll go through that a bit later in the webinar. So all these contributions are then locked away by your super fund, who invests the money in things like managed funds, cash, property, shares, and fixed interest. And because your super is an investment, it generates investment returns. So these returns are also reinvested throughout your working life, so your super can grow even further over the long term. Sorry, I just need some water. So the sooner you start contributing to your super, the more money you're likely to have when the time does come to retire. However, the rate of growth will depend on how your money is invested and how investment markets perform. So we'll look at that later too. And your benefits are generally preserved until you meet a condition of release. So before you can withdraw your super, you need to have either turned 65, even if you haven't retired yet, or retired and reached what is called your preservation age. So this is somewhere between the ages of 55 and 60, depending on your date of birth. If you do, however, start withdrawing your super before the age of 60, if you have reached your preservation age and it is below 60, you may be taxed on amounts that you withdraw, excuse me. But once you turn 60, you can generally withdraw your super tax-free. So let's look at some different types of super funds. So there are 4 main types of super funds available, and the right one for you may depend on how involved you want to be with deciding how your super is invested. So if you prefer to leave these decisions up to your super fund's investment managers, then you could choose from personal, corporate, or industry funds. So personal or retail super funds are usually run by financial institutions and are open to individuals. Corporate funds, which are set up by employers for their employees through a financial institution, may also offer group discounts and special benefits for members. And industry funds were originally for workers in specific industries, but they're now open to anyone. So Host Plus used to be only open to hospitality workers. That's one example. If you work in a particular industry or under an industrial award, your employer may choose an industry fund as the default fund for their employers' SG contributions. But if you want to take a more hands-on approach to managing your super, you could start a self-managed superannuation fund, or SMSF. So these are often referred to as the do-it-yourself super funds. Trustees or members of an SMSF are responsible for the investment strategy, the operation of the fund, administration and compliance of the fund. So let's quickly touch on the features and benefits of a SMSF. Why choose an SMSF? So it can give you greater control and flexibility over your investments. You can develop your own investment strategy and tailor your investment portfolio. It can offer greater choice around estate planning options, and you may also be able to borrow to invest, although there are strict conditions that do apply. So here's what you need to keep in mind about managing your own super. Firstly, it comes with significant compliance obligations. As an SMSF trustee, you need to make sure you meet them, as there are heavy penalties for non-compliance. The administrative responsibilities of your SMSF can be quite time-consuming and costly. The fees and admin costs involved can eat into your investment, and you may need to appoint auditors, tax agents, accountants, and financial advisors to help you run the fund. You also need to be quite a savvy investor to manage your super fund investments effectively. So generally speaking, if you have less than $200,000 in super, a regular super fund is likely to be a better option. If you do decide to set up an SMSF, we can of course help you, guide you through the process, and can also help you with financial advice in that area. I know someone. So let's just have a look at how the SMSF works. So if you'd like to, we have some great webinars on our website. And if you'd like to have a look, you can visit www.smartfinancialplanning.com.au. Type in the search bar, is an SMSF right for me? And you can have a look at this great webinar. Investment options. So a super fund's investment strategy typically includes growth assets and defensive assets. So growth assets are designed to increase the value of the amount you invest by earning higher returns over the long term. They can also, however, carry a higher level of risk, so particularly in the short term. So growth assets include Australian shares or international shares, property securities such as shares in property investments that are listed on the share markets. That also includes real property as well. Growth asset, real property is a growth asset too. Defensive investments, on the other hand, they're designed to provide you with a regular, stable income, so carrying a lower risk. However, that means that they may have less potential for high returns. So defensive assets include fixed interest, such as government or corporate bonds, and cash, such as money and bank bills. So you can tailor your super investment portfolio by choosing an asset mix that matches your investment goals, time frame, and appetite for risk. So for example, when you're young and you have plenty of time to grow your super, you might choose a higher percentage of growth investments that have the potential to produce higher returns over the long term for you. And these types of investments can also be more volatile because of the market movements, but having a long-term horizon can help you ride out any periods of volatility. And as you approach retirement, you might want to switch to a more defensive investment portfolio that offers lower but more stable returns so that you can keep your capital secure for retirement. So balancing a portfolio with a higher mix of defensive assets as you progress towards retirement or retire. So this provides you with a buffer against any short-term market fluctuations, while still allowing your investments to grow over time. So let's have a look at some percentages of growth assets and defensive assets. So most people, for example, in their super will automatically be put into a default risk profile, and that is quite commonly the balanced risk profile. So that's the one on the bottom left there. And the way we determine where you fit on the risk scale is by a series of questions and discussions to determine your risk appetite. So this will determine if you fit into a conservative profile, a growth profile, or a balanced profile. So every individual investor responds differently to volatility. So you have to decide for yourself how comfortable you are with taking on risk. So it can help to weigh up a few factors such as your lifestyle and financial goals, the amount of time you have to invest, your level of knowledge about investing and how the markets work as well. So understanding your risk profile will help you build out a suitable investment portfolio. So a defensive investor, they're focused on protecting their investment capital and having total peace of mind. A conservative investor prioritises safeguarding their investment and only takes on a small amount of risk. A moderate investor will create a portfolio with equal growth assets and defensive assets. A balanced investor will create a portfolio that takes on some short-term risk for potential long-term growth. A growth investor is prepared for some fluctuation in returns and aims for consistent capital growth. And a high growth investor has a high threshold for short-term risk in order to maximise the growth of their investment. So a great example of risk profiles making a big difference in your super is the comparison of two 25-year-olds working for 40 years until their retirement, each on the same income, and one of them has a growth risk profile, one of them has a balanced risk profile. And the person that's invested in the growth risk profile had $300,000 more in super from being invested in that growth risk profile when compared to the other one being invested in a balanced risk profile. So that is just an example, but it can make a really big difference how your super is invested. And also your investment risk profile in super may be different to your investment risk profile outside of super as well. You may have different timeframes, different goals in super versus personally. And also your risk profile may change over time if your circumstances change or your needs change. So let's have a look at some investing inside versus outside super. Okay. So super isn't the only way to fund your retirement. You may also be thinking about investing outside of super. The biggest advantage of investing in super is the tax effectiveness. So let's have a look at the difference it could make to the amount of tax that you pay on your investments. So as you can see here, your super is taxed at 3 stages. When it comes into the fund as contributions, when it's in the fund as investment earnings, and when it leaves the fund as benefits. Tax on contributions. So if you're investing in super from your pre-tax salary, you generally pay contributions tax of 15%, which is likely to be lower than your marginal tax rate. Non-concessional contributions don't incur any tax, as they're often taken from your after-tax, as they are taken from your after-tax salary. Tax on investment earnings. So your earnings inside super are taxed at a maximum rate of 15%. And then they're not taxed once your super moves into retirement phase. On the other hand, investment earnings outside super can be taxed up to the highest marginal tax rate of 47%, including the 2% Medicare levy, depending on your income. Tax on benefits. So if you're age 60 or over, you can usually access your super tax-free, either as a lump sum or as an income stream. However, if you do, as mentioned earlier, access your super before the age of 60, if your preservation age is between 55 and 59, there may be a taxable component. So this can have a major impact on your investment over time. So on the right, you can see here a table showing what can happen when you invest $450,000 in super, compared with if you invested that same amount outside of super. So for instance, in a managed fund. So for this example, we've assumed the marginal tax rate of 34.5%, and that both investments are earning equal returns of 7.7% per year. So as you can see, only after a year, you would be over $6,000 better off if you put money into super. And after 10 years, this figure has reached over $112,000. So this could make a big difference to your retirement lifestyle. And this is because investment earnings in super are taxed at the low rate of 15% compared to your marginal tax rate for investments outside of super. So let's have a look at some smart super strategies. So there are two main types of super contributions. Firstly, we have our before tax or concessional contributions, which include those compulsory SG payments from your employer that we talked about earlier, which are currently 10.5% of your income. If you have an employee, you can salary sacrifice if you are an employee, you can salary sacrifice some of your pre-tax salary into super, which we'll discuss in more detail in a moment. If you're self-employed or an employee, you may be able to make pre-tax personal contributions and claim a tax deduction on them. Then we have our after-tax or non-concessional contributions. So these include contributions that an employer makes on an employee's behalf from the employee's after-tax salary, an employee or self-employed person makes from their own after-tax money, or a spouse makes to their partner's super account. So we'll delve more into non-concessional contributions later. And lastly, if a person aged 55 or over from the 1st of January 2023 sells their home, they can make a downsizer contribution from the sale proceeds as long as they've met strict conditions. So downsizer contributions are capped at $300,000 and not considered as either concessional or non-concessional contributions. It's also important to be aware of the age restrictions around personal contributions. So while you're still working, your super fund will accept contributions from your employer regardless of your age. And from the current financial year onwards, if you're aged up to 74, all contributions into super can be accepted within the contributions caps. And once you turn 75, you can no longer make personal contributions. Your fund will only accept your employee's SG payments or downsizer contributions. Strategies for topping up your super. So salary sacrificing can be an easy and tax-effective strategy for growing your super, particularly if your marginal tax rate is high. So here's how it works. You make an arrangement with your employer, authorising them to take a set amount each paycheck before your income is deducted, and your employer then deposits this amount directly into your super account, along with their compulsory SG payments. The benefit of this arrangement is that you don't need to pay income tax on any amounts you salary sacrifice. Instead, these amounts are taxed at a maximum of 15% when they go into your super account. Although your super contributions are taxed, this 15% tax rate is likely to be lower than your marginal tax rate, which could be as high as 47%, including the 2% Medicare levy. So sacrificing part of your salary also reduces your taxable income, so that's your take-home income, and may even push you into a lower tax bracket. So depending how big your contributions are. The 15% tax rate on super is also likely to be lower than the tax you'll pay on any investment earnings outside of super, which are also taxed at your marginal tax rate. However, there is a concessional contributions annual cap, which is currently $27,500 in the current financial year of 2022-23 for concessional contributions, and this includes all of your employer SG payments as well as any personal contributions and salary sacrifice amounts. And if your total super balance is below $500,000, you may be eligible to contribute unused concessional contributions into your super. So for example, if you made $7,500 worth of concessional contributions in 2021-22 financial year, and you had a total super balance of $500,000 or less on the June 30 of the previous financial year, you would be able to make $20,000 of unused concessional contributions into your super. So the ability to accrue and carry forward these unused amounts of concessional contributions only started from the 1st of July 2018. And these accrued unused amounts can only be carried forward for up to 5 financial years. It's also worth noting that if your annual income is above $250,000, you'll also be charged an extra 15% tax on some or all of your concessional contributions. So let's have a look at after tax or non-concessional contributions. So you can make non-concessional contributions from your after-tax salary up to the cap, which is currently $110,000 a year in the financial year 2022-23. But if you're under age 67, then you can choose to contribute up to $330,000 non-concessional contributions at any point during a 3-year period by applying the bring forward rule. So to use this rule, there are specifics that we need to work around. So your total super balance on the previous 30th of June financial year has to be less than 1.4 million. The total super balance includes all your super accounts that you have with any provider, including pension phase amounts as well. If your total super balance is between 1.4 million and 1.6 million, you may have a reduced bring forward amount that you can use as well. So it's always best to check these. Also, once your total super balance reaches $1.7 million, or from the 1st of July 2023, $1.9 million, your non-concessional contribution cap will be reduced to nil. So if this happens, you won't be able to make any more non-concessional contributions to your super account. Okay, so let's bring on the next slide. So we've got concessional and non-concessional contributions being the main ways to contribute to your super, but there are other ways as well. And one great way is spouse contribution splitting. So that's a strategy that allows you to transfer a proportion of your concessional super contributions into your partner's super account. So this can be done by couples who are married or in a de facto relationship. And the person making the payment can transfer up to 85% of their concessional contributions from the financial year into their partner's super fund. So the person making the concessional contributions will still get that tax deduction for making those concessional contributions, and then they can split up to 85% of those contributions into their spouse's super fund. So to be eligible, the person receiving the payment must be either under their preservation age or under age 65 and not retired. So some of the reasons this might be an effective strategy, if you're wanting to equalise your balances, your super balances over time, to allow you to maximise future super contributions. If you've reached the $1.7 million transfer balance cap on the amount you have in the retirement phase of your super, to make the most of your potential tax advantages, and to enable the older partner, if you're not the same age, to access more money in retirement sooner. And it is also used to increase the older partner's age pension entitlement in some cases. So not all super funds allow the co-contributions, so you will need to check with your super fund before proceeding with this and taking advantage of this strategy. Now let's have a look at assistance from the government. So the government offers a super co-contribution to help low-income earners save for retirement. So if your total income is less than $57,000 or less, you can make a $1,000 after-tax contribution to super, and the government will make an additional contribution up to $500 to your super. So in this case, your annual income includes amounts that you've salary sacrificed and also reportable fringe benefits. The amount of the government co-contribution reduces 3.33 cents for every dollar that you earn over $42,016, up to the maximum income threshold of the $57,016. So this is a great way to top up your super and get an extra boost from the government. So what about insurance held in super? So do you know the insurance options that you hold in your super account? So let's have a look at what insurances can be held in your super. So life insurance is a lump sum insurance payout to your chosen beneficiary if you pass away, or a lump sum payout to you if you have a terminal illness, and can be held in super. TPD, or total permanent disability insurance, is a lump sum payout to you if you suffer from a permanent disablement, meaning that you're unable to work long term. And that can also be held in super. Income protection is a monthly benefit paid to you if you're unable to work due to a sickness or injury, and that can be held in super. And the recovery or trauma insurance, that's a lump sum benefit paid to you if you were to suffer a trauma incident such as a heart attack, stroke, cancer, but that cannot be held in super. So the life, TPD and income protection insurances can be held in your super fund and paid from your super fund. It is good to note that any insurance benefits that you claim would also then be paid into your super fund. So particularly with income protection insurance, it's really good to be aware of this, as there is some circumstances it may be better to hold income protection insurances outside of super. So when you've created a comfortable lifestyle for yourself and your loved ones, it's worth thinking about what would happen if you were unable to work for a while because of an illness or injury, and how would you or your family cope financially, not only with the costs of medical care, but also keeping up with regular expenses such as mortgage payments, bills and school fees. So insurance is an important way of ensuring that your family and your business and your loved ones will always be looked after no matter what happens. And it provides a financial safety net to support you and your loved ones if the unexpected occurs. So the way that the insurance works is that you pay a premium on a regular basis, monthly or annually, and your beneficiaries or yourself, depending on the insurance, receive a payout in the event of an illness or accident or passing away. So the money that you put into your insurance cover is working to protect the things that matter most: your family, your health, your income, your business and your lifestyle. And your insurance cover may differ as you move between stages of life. So as you move from one stage of life to the next, you face different types of risks, which means that the types of cover that you have may change, or the benefits may increase or decrease depending on your needs. So in the early years of your adult life, you're just starting out in your career and you have fewer financial commitments. So because you're in good health, this is a really good time to implement insurance. And your need for the life and TPD and trauma insurances may be lower. The benefit need may be lower. However, it is a really good advantage to put them in place, even if it is at a lower level. So great little tip there. So in the next stage of life, you might be getting married, raising a family, buying a home. So you're probably juggling your work commitments with financial responsibilities of supporting your family and paying off a mortgage. So this means your need increases for insurance, such as income protection, life, TPD and trauma insurance. So you may increase the benefits during that stage of your life to have your loved ones fully protected in case something were to happen to you. And after your children leave home, the financial squeeze eases, and you may be focused on growing your wealth and paying off your mortgage so you can enter retirement debt-free. And as you approach retirement, however, your health risks increase. So making the personal insurance cover very necessary, since any period of time taken off work during these times can make a significant difference to your retirement savings. Once you retire and no longer have an income to protect, your financial focus may shift to preserving your wealth to fund your retirement. So the potential for increasing medical needs, so it makes sense to maximise your life, TPD and trauma cover at this stage, as maintaining your health becomes a priority. Do you know how much your super fees cost you? There are lots of fees in super, so let's go through them. Administration fee. So they're charged by your super funds to cover the general cost of managing your super account. And this can cover expenses like the super fund's call centre, the cost of issuing annual statements. They can be charged as a fixed fee or as a percentage of your account balance or as a combination of both. Many super funds cap the total admin fees that they charge in a year. And if you do have an account balance below $6,000, your admin and investment fees are capped at 3% of your account balance. Investment management fee. So this fee covers the cost of managing your investments. So this may cover fees paid to investment managers, amounts paid to external parties such as brokers and government authorities. It's usually charged as a percentage of your super balance and can vary based on your choice of investment option too. So in some cases, the investment fee may also include a performance fee. So Some super funds charge a separate performance fee once certain targets have been met. Generally, fees are calculated as a percentage of the investment returns that exceed an agreed level of return and are often capped at an upper percentage limit. Advice fee. Some super funds offer general advice for free, and some will charge you a one-off fee. The personal advice provided to you about your super and other investments by an advisor.
And we've had many clients that have said, oh, I'm not getting advice from my super fund. And we'll say, no, well, actually, you've paid them about $4,000 over the past 12 months. And people will say to us, no, I haven't. And we'll look it up. And what they've done by mistake, in a sense, is, the super funds ask the question, would you like us to provide you advice? And so they've ticked the button, yes. And, whether that advice has then been provided, hasn't always been evidenced, but has been a fees charged on that. So it's worth having a look at that in your settings as well.
Yes, definitely. Investment switching fees. So some super funds charge a fee for switching your investment option. For example, if you were to switch from a balanced investment option to a high growth one, or vice versa, they may charge you a fee. And some funds may also charge a buy-sell spread fee. So the buy-sell spread fee. So when you make contributions, withdrawals, or switch your investment options, you're buying or selling investment units. So the buy-sell spread fees cover the difference between the buying and selling price and are charged by some super funds. The types of fees and the amount charged will vary depending on the super fund and product. So read your annual statement to find out how much you are paying. And you'll also be able to find out the fees on the super fund's website.
Yeah, and the frustrating thing about the buy-sell fees is, technically speaking, so this is a lot of the retail funds and the industry funds, and actually the industry funds are quite big culprits of this. But technically speaking, those funds do not have to disclose those buy-sell fees to you in your statement. So when you get your statement, and what you're seeing up here on the screen is an example of that. And they will actually have little asterisks saying, we've charged you these fees. So in a sense, you can see on the screen there, fees paid for administration, fees paid for advice, and you've got those fees there. What they don't disclose to you, because technically, apparently, a buy-sell spread fee is not exactly an actual fee that they're required to disclose to you and quantify that on your statement. So you would be absolutely unaware that statement, and so we will look up the PDS. Now, probably most of you are not that excited to look up a PDS, a product disclosure statement, on your super fund, nor actually have a look at the annual report of that. Now, if I use one of the industry funds, every year in their annual report, all of them do it, they will actually say the average buy-sell fee that we charged was, and they'll have a percentage. So, for example, in this example here, the buy-sell spread fee was 1.1%. Now, people look at theirs, and you probably all know the industry funds that, that say, oh, our fees are the lowest and here's what we charge. But what they're not telling you is this buy-sell spread, that you add that on top of it, and the fees do come up a lot. So when we're looking at your super funds and as to which is the most appropriate super fund for you to be in and what are the fees that you're paying now in your super, we're not only looking at the actual fees they're required to disclose, we also go back to the annual reports and see, well, what was the average buy-sell that was charged for the prior year, so that we can actually tell you what that cost is. And that's where there's a cost where basically they've bought an investment on your behalf for 100, but it actually only costs them 95, and they get to keep the $5 fee as the difference, so to speak, when they're doing that with your super. So that's always important to understand what that buy-sell spread fee is, because I think that's a bit of a hidden fee that apparently technically is not a fee, is what their the definition is.
Yeah, that's very good advice, actually. Also, if you have more than one super account, you may be paying fees on both accounts. So if this is a case, you might want to have a check and consolidate your super account so you're not paying two fees into one account. So before you do so, check with any of your super funds to see if there are any related costs or insurance cover that you might lose if you were to switch funds. Some people will automatically receive insurances such as life, TPD and income protection insurance through their super. And the premiums are taken out of their super balance, which will appear in their statement. So it might be a good idea to consider coverage offered and to understand what you are receiving and whether it suits your needs. You may have the options to increase or decrease the coverage by contacting your super fund, and you may be able to opt in and out of this insurance if you so choose as well. So it is important to update your superannuation estate planning or binding death benefit nomination in your super. So a binding death benefit nominations means that your super benefit, your account balance and any insurance benefits must be paid to the beneficiaries in portions that you set out in your request. A non-binding death benefit nomination are those that you, beneficiaries are those that you wish to receive your super and any insurance benefit upon your death, but a non-binding nomination is not formally binding on the trustee and only acts as a guide for the trustee in deciding how your death benefit is to be paid. Your nomination may also be lapsing or non-lapsing. So if it is lapsing, then you will need to update it every 3 years. If it's non-lapsing, then you won't need to update it unless you want to change your beneficiary nomination. If you do have an SMSF, it is important to put in place an SMSF will, which is the equivalent of a retail super binding death benefit nomination. So the SMSF will are directions made by the SMSF member you nominating your super benefit, your balance account, to be paid to the beneficiaries that you choose. So estate planning is working out the best way to handle your affairs after you pass away and how to protect the assets in the best interests for yourself and for your beneficiaries. So this will give you peace of mind having these updated in your super accounts. So how to access your super. This is an important area for us to run through. Got all this money investing over the years, and how do you get to it? So as we discussed, your super is locked away until you turn 65 or you reach preservation age and retire. So that at this point, you have 3 main options to access your super. So you can leave your super in the fund where it is, cash it out as a lump sum, or convert it to an income stream, such as an allocated pension or annuity. So if you leave your super where it is, you won't receive a regular income. It'll be staying in accumulation phase and you'll continue to pay the 15% tax on your investment earnings. So many retirees think that they should cash out their super as soon as they retire to preserve their money. However, if you do withdraw your super before the age of 60, the withdrawal may be taxed. And remember, if you move your money to another investment vehicle outside of super, your investment earnings and any withdrawals you make will also be taxed at your marginal tax rate. So let's have a look at converting your pension. So an account-based pension, that can provide you with a regular income stream from your super once you've reached preservation age and retired. And the more super you invest in your pension and the higher the investment earnings, the more income you'll receive over time from your pension account. So between your preservation age and age 59, you'll receive a 15% tax offset on any taxable income you withdraw. And once you reach age 60, your pension income is usually tax-free. You can also make lump sum withdrawals whenever you need to access cash, which can also be tax-free after the age of 60. You must take a minimum percentage, as mentioned earlier, of the account balance as income each year once you draw down once you do retire. And if you do make a binding death benefit nomination, your beneficiary can receive any remaining account balance when you pass away. So all these factors make account-based pensions one of the most flexible retirement income streams available. So annuities, on the other hand, pay a regular income for a specific time frame using money from your super. So there are two main types of annuities: the fixed term annuities, which pay a guaranteed income for a defined benefit period of time, say 5, 10, 20 years, or a lifetime annuity, which pays a guaranteed income for the rest of your life. So the payments you received are determined by the amount you invest and the time frame that you choose. Your investment returns are mostly guaranteed, depending on which product you go with. So if you go with a product that's not market linked in an annuity, then your annuity will not go up and down with the market movements. And then many of the annuity providers also offer the option of automatically increasing your income payments in line with inflation. So another thing to keep in mind is how your pension or annuity counts towards the Centrelink assets test. So this could affect how much government age pension that you're entitled to. And these rules can really depend on the type of income stream, when you purchased it and how much you purchased it for. So it is best to speak to an advisor or to Centrelink about the treatment of this. An important thing to understand also is that you don't have to choose just one of these options. You can choose a combination. You might want to withdraw a lump sum from your super account once you retire, pay off debt and divide the rest into an account-based pension and an annuity. There's also flexibility around how you retire. So you could do a transition to retirement strategy. And that's a way of easing into retirement. So it enables you to start accessing your super while you're still working, as long as you've reached your preservation age. So with a transition to retirement or TTR strategy, you can actually keep making concessional and non-concessional super contributions while drawing down an income stream from your super at the same time. So this can give you more flexibility in choosing when and how you retire, so you can achieve the lifestyle balance that you want in the final years of working. So there are a couple of key strategies with TTRs. One is tax driven and the other is lifestyle driven. So the first strategy is tax focused, and that involves continuing to work full time and increasing your salary sacrifice contributions to super to supplement the reduction in your income. So you can convert some of your super to a TTR income stream and draw on this income stream to make up the difference. And from the age of 60, this strategy can offer significant tax advantages that can help you build your super faster, depending on your marginal tax rate. The second one is lifestyle focus. So that's more about flexibility, giving you the opportunity to make a gradual transition to retirement. So in this strategy, you might move to part-time work or reduce your hours. Then you might draw a transition to retirement income stream to supplement your income. So this can improve your work-life balance in the lead up to your retirement. There is a danger in that you might draw down too much super too early. So that is always keep an eye on that. So in summary, a TTR strategy can broaden your retirement planning options by allowing you to reduce work hours without losing income or making the most of tax concessions in super. You do need to be very careful though, because you don't want to draw down too much of your retirement savings too early and have your lifestyle impacted later. So if you are considering a TTR strategy, it is a really good idea to talk to a financial advisor in your pre-retirement years. From the 1st of July 2017, the total amount of super you can transfer into a tax-free retirement account is capped, and this is called your transfer balance cap. So the general transfer balance cap began on the 1st of July 2017, and this is a lifetime limit of the total amount of super that can be transferred into tax-free retirement phase income streams, so including pensions and annuities. So this was created to produce a tax-free retirement income stream, and anything above this TBC, transfer balance cap, stays in accumulation phase in your super and is still subject to the 15% earnings. And then on the 1st of July 2021, the transfer balance cap was increased to $1.7 million. And then from the 1st of July 2023, the transfer balance cap will increase again to $1.5 million. So this means that the most that you can transfer into your retirement phase of your super at the moment is $1.7 million. So that includes most income streams such as pensions and annuities. And if you go over this cap, you may need to pay extra tax and move the excess back to the accumulation phase of your super. Different rules do apply if you do have a defined benefit pension or term allocated pension. And if you are nearing that transfer balance cap amount, a financial advisor can help you tailor your retirement strategy so you won't be penalised. So it's now time to pass over to you, Shannon, to go through taking control of your super.
Great. Is that
slide goes? There we go.
Yeah. So how do we start taking, how do we take control of our super? Yeah. Great. Do you want to push to the next slide? Sorry. Yeah. So really looking at when you do want to take control of your super, and at the end of the day, it is going to end up quite a significant asset if you plan well enough. Now, you know, it could be you've got a few years left till retirement. It's never too late to actually look at creating a plan. And as Bianca talked about before with the TTR strategy, so you transition to retirement, even looking at financially modeling, if you keep doing what you're doing now, what does retirement look like? And what would a different strategy and how would that impact? So really, you know, an action plan, I'd say, you know, set your lifestyle and financial goals for retirement. I mean, often we're so busy with everything that's going on today. You do need to think about retirement and how you can have a good retirement and have a goal of not relying on the government pension, because I don't think that, even though they say it's going to be a very comfortable lifestyle, I'm not sure how comfortable that is in not having to rely on that. So having a goal of not relying on that, calculate how much super you're going to need. Now, that's something that we can help you with. That will be dependent on, you know, what will be your position at retirement with your house. You know, do you own your house or you're still renting? What does retirement look like? So how many holidays do you want to do? You know, will you downsize? What other aspects do you have? And then what we do then is look at, based on your investment risk profile, so that I call that the ability for you to sleep at night no matter what goes on with the markets. It's that kind of gauge in making sure that we choose the right asset profile for that. And then tailor a strategy for you to boost your super so you can still enjoy living today, but also be building up for your super to tomorrow. And then decide how to access your super. And as Bianca talked about before, so we've got, you know, whilst you can access your super from age 60. You know, we've got age pension that's moving from like the 60 to 65 to 67. But from accessing your super at age 60, just because you can access it at that point, is that really in your best interest? Or do you want to access, what happens if you do access it before 60 and do this transition to retirement? What does that look like for how long your retirement superannuation is going to last you? And when would you potentially run out? Or will you have still a nice big asset left, you know, at life expectancy when we model it through, and therefore maybe, you know, you should enjoy life a bit more, or how much you're intending to leave for the kids' inheritance, so to speak. But with any of those, do seek professional advice, because we can financially model that out to really give. And I guess the biggest kind of feedback we get from clients when we're modeling out the financial, where you're going to be from a superannuation perspective, is probably peace of mind, which I kind of underestimated the impact of that in being able to financially model, well, this is what you're going to have. And this is the point where maybe you then at that point can start tapping into the age pension. Maybe there are other opportunities. Maybe we can tweak some of the ways in which you have some of the investments. You know, the annuities that Bianca talked about is something that some of those are not fully counted from an age pension perspective. So what can we do at what point in time to enable you to get maybe some of that tax money you've paid to the government back as a bit of an extra on that side? So it is worth you know, getting that advice and trying to get that sorted out up front. So how we can help you as financial advisor, looking at lifestyle goals, looking at where you're at personally, what do you want to achieve today versus tomorrow versus then in retirement, and help you with the cash flow. And that's something that we're seeing a lot more now with our clients, is working with them on personal budgets, because I think there's been a bit of a tight squeeze over the last few months. So working with clients on how they can look at their personal budgets, knowing they'll never love accounting as much as we do. But some of them are, you know, they're actually getting quite excited at how they're going with their budget and keeping themselves on track. We can have a look at strategies on how you would pay off your debt and when's a good time to pay off certain particular debt. You know, some clients say, I really just want to pay off my home loan as soon as possible. Now, if you do that and in 10 years' time, you say to me, okay, now I'm ready to invest some money, I've paid off my home loan, I can financially model and say to you, well, if you didn't pay off that home loan in 10 years and we did it over 15 years and we did some other investments, what would your net wealth look like between the two scenarios? And so looking at those options, and then also looking at the insurance side, which we all, hope that we never actually have to claim on our insurance, and that our insurance has therefore been a waste of money somewhat. I'd rather never to have to claim on it, but we've seen too many clients where we have had to claim on it, and it has made such a difference. So I think the more I see the claims coming through, the more I guess see the benefit of insurance, albeit I actually kind of ideally never want to have to use it, if that makes sense. And then working out how we can get from a retirement perspective. So there's lots of things that we can do for you in assisting in some of those areas, and give you some clarity on what the numbers would look like as well. So we'll open it up to questions. I know we've got one comment here. So I'm just commenting about the defensive investments. First half of 22, found that was responsible for a significant fall in your super balance, which, yes, probably was due to rising interest rates and depending on what those fixed interest investments were. The last 3 years have seen a lot of ups and downs in all the different asset profiles, unlike what we've ever seen in a sense before, even through the GFC time as well. We've got a question here on how long will how do I know how long will my super balance last? And that's something, I think we've touched on it a little bit now. You had the question before, we touched on some of it, but also it's having a look at, well, what does retirement look like to you? What do you want to do in retirement? Is that a holiday? What type of holidays is it that you're looking at? And so that's where we work out what would be your future retirement living costs, what position would you be in with your house, and then actually financially modelling the investment side of your super and the drawdown side of your super, which is your drawing down, which will often be maybe the investment return, but also some of the, I guess, capital in your super to fund your lifestyle, and as to how long that might be available. And I've got just then one other, but if you do have any other questions, please put those in. So I've just got one other. How do I know how much extra should I put into super? So when you're looking at how much extra should you be putting into super, again, that comes down to what can you afford today? So not inhibiting your day-to-day now. Yes, you get a tax deduction on it, but also what does that mean from an overall? So it comes down to a bit the financial modelling side of things to work out the economics of where that's going to be in the long run, and just putting that little bit extra in, the difference that can make. And another question, if I have moved into pension phase, can I add to my pension, or must I have an accumulation account? So you will actually need to have an accumulation account. Now, you can actually end up with literally, we have some clients that even have 12 pensions. We actually summarize it for them and say, this is how much you need to draw each year as a total. Now, the reason for that is it does need to go into the accumulation. That's not such a big deal to have an accumulation, and then you might get to the end of that year and then roll that over into your pension phase at that point. And that's how some clients have done that on a continual basis, while they're still able to contribute to super, but they're able to draw down on their super as well. So yeah. So with the figures that we shared at the start, do they incorporate inflation, considering where things will land in 20-ish years' time? Those ones are as at today, and then with some investment returns, they do say they have inflation in. They were done as at last September, and I'm guessing the inflation rates would not be as great as what they would have used then. It would not be as significant as what we're seeing now. So that's something that when we financially model it, we actually add those inflation, and we financially model right through to life expectancy. Everyone always asks us when that is, but we just go based on what the industry says it is going to. Another question, once your partner's super balance reaches the 1.7 or 1.9 million, can all of their super contributions go into the partner account? No, so what happens there with the spouse contribution, once it's in their account, that stays. The spouse contribution, what that is each year, so if your partner has $27,500 put into their super. Now, especially if they're getting around that 1.7, so this will be some of the strategies that we could look at doing. But if your partner is getting around one of these caps, you know, whether it be nearly at the 500,000 or nearly at the 1.7, so the different caps that trigger different implications. If you have that situation and they're contributing $27,500 to super each year, then what you can do is whilst that gets pushed against their concessional contribution, you then advise the super fund, please don't put that full amount in my partner's name. Please put, or they're directing, I want 85% of my super contribution, so 85% of my 27,500 to be actually put to my spouse. So there's no tax consequences for you, but it's just on those amounts. So it's not a matter of your actual overall super balance at the end. It's only on those contributions, the spouse contributions, that can 85% of the 27.5 can be actually reassigned, for lack of a better word, to the spouse. But it is great to actually help manage the balance, your overall member balance, especially if you're getting to some of these stages where, you know, it could be a little tricky. So there can be some really good tax benefits on being able to do that. If your partner has a significant balance and your balance is really low, what we do with clients there is we literally have every year, at the moment, 85% of their concessional contribution is going to the partner to try and build up the partner's super balance, because that's going to be beneficial overall. No point if your partner ends up over the maximum cap and now is paying 15 cents in the dollar and you're sitting on, you know, 100,000 super, if we could have contributed and pushed some of that across to equalize it. Okay, well, I think that's answered everyone's questions. Okay, great. Well, we do have a lot of, and I'm sure you're getting over everything with Netflix these days. We do have a lot of videos, as Bianca highlighted, on SMSF. We've got a number of them, buying property in SMSF. I always say feeding your property addiction with your SMSF is what I like to call it. But we have a number on SMSFs. We've also got, and Bianca touched on, estate planning. So we do have some on estate planning and what to look at when you're looking at your wills. How can you make sure that you know, things go to where you want it to go? So have a look at our YouTube channel. You can subscribe and you'll get notified. This webinar will be on there if you want to watch it again as well. So there'll be something up there as well. Thanks very much, everyone, for coming along. Well done, Bianca. Thank you very much. And we'll see you all for our next webinar. Thank you.
Thank you, Shannon. Thank you, everyone.